Today I'm going to teach you what flag patterns are and how to successfully trade them. Stay tuned. How's it going, guys? Ryan here again with another episode of my trading guide series, and today we're talking about flag patterns, what they are, the different types of flag patterns, and how to successfully trade them. Learning different types of patterns such as the flag pattern is fundamental in being able to successfully pick stocks, when to buy them and when to sell them. So let's get straight into it. What are flag patterns? Flag patterns are essentially a pattern where there's a sharp increase or a sharp drop in price followed by a period of consolidation of the share price over a period of time. Now this can be a long period of time over the space of a few weeks or a few months, or it could be in a short period of time of a few days or even on the hourly chart. Now the spike in price effectively forms a pole-like figure, and then when it consolidates that forms what appears to be a flag shape, which is where it gets its name as being a flag pattern. Now, as you can see here, there are two key types of flag patterns. You have the bullish flag pattern and the bearish flag pattern. The bullish flag pattern is where the price spikes and then consolidates and then eventually breaks out of the trend in an upwards direction. Whereas the bearish flag pattern is the opposite. It goes down quite severely and then consolidates a bit, then continues to drop outside of the slight trend that it made. As you could see, the spike in price or the severe drop in price formed the pole type shape, and then the flag was formed by the consolidation of the share price. What you really want to look out for is where the flag pattern is actually forming. So is it forming in an uptrend or is it forming in a downtrend? Generally, a bullish flag pattern will occur in an uptrend and indicate a continuation of such, and likewise with a bearish pattern, it'll indicate the continuation of a downtrend and will likely always occur in that sort of area. So let's look at some real life stocks. Here's an example of a bullish flag pattern. You can see the price spiked significantly, and there was a period of consolidation where the price eventually broke out of the channel or the flag that was formed and spiked upwards once again. Now if we look at a bearish flag pattern, you can see that the price has dropped quite severely to a point where the pole is formed and then it starts to consolidate over the period of a few days into a flag type shape within that channel, and then you'll see that the price drops underneath the bottom channel line, indicating that it is going to continue to drop in value and the downtrend will continue. Now another example of a different type of flag pattern is a pennant flag pattern, and effectively it's the same thing, but the price fluctuations gradually decrease to the point where there is not a rectangular shaped flag. Instead it is a triangle and forms into a point, and when it hits that point it'll either break upwards or downwards depending if it's bullish or bearish. Now that you know what flag patterns are, how do you take advantage of them? And the first key thing to do is identify the trend. You need to identify whether the stock is uptrending or whether it is downtrending. Once you've worked that out, you need to identify a bullish flag if it's in an uptrend, because that will indicate that the trend is going to continue. You want to see a good period of consolidation to confirm that it is a flag, and it needs to be in a channel which is relatively even and rectangular in shape. Effectively, what you should do is buy somewhere within that channel, particularly to a point where you think it's going to break out. Buy the share and then hopefully it should break through the top of the flag. Alternatively, you can actually wait until it has broken out of the top of the flag, because that for you will indicate that yes, a breakout has occurred, and then you're jumping on the ride as it starts. Alternatively, you might see a bearish flag pattern in a downtrend, and for you, if you're holding a share for instance, that might indicate okay, you should sell if it drops out of that flag, because the continuation of the downtrend is going to occur. Alternatively, if you are short selling or betting against the stock, then a downtrend is what you are after, because you want to see a drop in price. So a bearish flag pattern may indicate that it's going to continue and you can start shorting that share. The key thing here is to really understand what the current trend is, because if you identify a bullish flag pattern in a downtrend, then it is likely that it will fail and you'll end up buying a stock and it just drops in price quite severely. Likewise, if you see a bearish flag pattern when it is in an uptrend, the price will likely not go in the direction you're expecting. Now, this may not always be the case, but in my experience, I prefer to go with the trend. So if I see what appears to be a bullish signal in a downtrend, I'll tend to avoid it unless I've got significant confirmation that there is a reversal in the share price's direction. That's all for today, guys. I hope you enjoyed the video. If you did, please make sure you leave a thumbs up. It helps me out a lot, and subscribe for more content. If you've got any questions or comments, please leave them down below. I'm more than happy to answer them for you. And with that, happy trading. Have a good day. Cheers.